Here is the overview of today's gold market news. Gold price trends and performance. Historical performance and future expectations. Federal Reserve and economic policy. Here are the latest gold price trends and performance. Gold prices are currently high, around $2,516 per ounce, driven by expectations of an upcoming Federal Reserve rate cut. Gold began a sharp rise in February, reaching to $1,070 per ounce. By March 28th, it surpassed $1,300, and on April 5th, it exceeded $1,400. It achieved a historical high of $2,500.70 by May 24th. After a brief dip, current prices for December futures are at $2,554.60. Gold prices in 2024 have surged significantly, setting new records and demonstrating resilience despite market challenges. The surge suggests it continues to be a strong safe haven asset and inflation hedge. As economic uncertainties and geopolitical concerns persist, gold's upward trend may continue. Despite a strengthening U.S. dollar recently, gold has continued to perform well. The U.S. dollar index has declined from above 106 to around 101, yet gold prices have remained high. Despite recent short-term volatility and drop in gold prices, after release of the Personal Consumption Expenditure Price Index, gold remains above $2,500 per ounce, reflecting its ongoing strength. Let's look at the historical performance and future expectations. According to analysts, gold prices often rise immediately after the first rate cut to about 1.6%, but drop to 2.5% in the short term, typically 1 month later, based on historical data. Gold has historically struggled during immediate crises and economic disruptions, such as the global financial crisis and recent mini-crises like the Japanese carry trade unwind in August 2024. Over a 6 to 12-month period, following the initial rate cut, gold prices tend to perform well, with an average increase of more than 7.7% and a positive return more than 75% of the time. Post-rate cut environments often involve quantitative easing, which increases liquidity and supports gold prices in the longer term. The outlook for gold will depend on the stability of the economic environment and the specifics of the Federal Reserve's actions. If the rate cut occurs during a period of economic stability, gold is expected to perform well over the medium to long term. Here are the latest update on the Federal Reserve and economic policy. Federal Reserve Chairman Jerome Powell has indicated that a rate cut is likely, with expectations rising for a potential reduction in September. The current base rate is at 5.25%, a high not seen in over 2 decades. Analysts, previously predicting a 25 basis point cut, are now considering the possibility of a 50 basis point cut. JP Morgan has even projected a 100 basis point cut by the end of the year, which would require at least one significant cut and to smaller reductions. Recent economic data shows rising unemployment in metropolitan areas and softening worker demand, while productivity is improving. This mixed data challenges the Federal Reserve's dual mandate to manage inflation and maximize employment. Powell's Jackson Hole speech suggested a shift from a gradualist approach to a more responsive strategy, adjusting rates based on evolving economic conditions and risks. Federal Reserve officials, including Powell and Austin Goolsbee, are concerned about maintaining high rates too long, which could negatively impact employment. Goolsbee highlighted that current conditions do not suggest an overheating economy. Financial markets are reacting to these potential changes in Federal Reserve policy. Analysts agree that their evolving risk bias suggests a significant rate reduction could be on the horizon. Economist Professor Jeremy Siegel advocates for an immediate rate cut to 4% or lower, suggesting that Powell's recent comments indicate a shift away from using high unemployment as a tool to combat inflation. If the Federal Reserve does not cut rates this year, it could risk pushing the economy toward recession, although no recession is currently predicted. Some analysts believe a rate cut is essential to avoid economic downturns.